A big thank you to all of my listeners. And if you would like to support this transmission even more and boost your trading account, go to trendfollowing.com/now. And without any further delay, on to today's show. This is Trend Following Radio, where great thinking comes alive. Nobel Prize winners, legendary traders, best-selling authors, and the pros that know what drive us irrational human beings. I am your host, MICHAEL COVEL. Not filtered, raw, honest. That's my passion. My guest today is Norton Reamer. He is the former Chief Investment Officer and CEO of Putnam Investments. He also founded for 20 years and ran United Asset Management. 50 years of experience on the street. Norton brings a wealth of insights. Today we discuss his new book, Investment, A History, from Columbia Business School. A great read, a really, really detailed anthology of investment, literally going back 2,000 years. Again, I'm very lucky to have Norton on my show today, and he's 80 plus years young, sharp as a tack. I can only hope I can get to that point. I hope you enjoy this conversation with Norton Reamer. You want people to know, and we are at a point in time now today where investment really is for everyone. However, you do point out that yes, we need the regulation. We don't want more Madoffs, but you're very clear on your personal responsibility message, meaning, there's diversification might be a free lunch, but it's still going to start with you getting an education.
Absolutely. That was not how I started this project, but it certainly is the way I finished it, in the sense that as we worked on this area, and I'll talk a little bit, if I may, about how I got into it, but as we worked on this area, we realized that the so-called democratization of investment, which is very much the central theme of this book, is not the same as making everyone equal or equally knowledgeable. And it comes with a responsibility to try to understand what your options are and what your risks are when it comes to investing. We end the book by bemoaning the fact that not enough of us have taken the trouble to take on responsibility for our own investment well-being and as a result, the investment well-being of our families and so on. And we urge that on people, and that's what this book is intended to help. If I may take a moment, though, I'd like to talk about how I started this project. I ran 3 companies, as you know, in my career, and the third one had been sold, and I was working to help them continue to do a decent job with the new company they acquired from me and us. I found it didn't take all of my time. It occurred to me that I've been working for 50 years plus in an industry that was, very exciting and lots of fun and rewarding for me personally, but I really had never delved into the history of that subject. And then I was astonished to discover, as I looked around, that nobody else had either. It's amazing. There are hundreds of thousands, I would assume, books on investment, but nobody ever took the trouble to dig into the history of investment and learn what could be learned from the past. And that's became my project for at least 5 years, and with 10 research associates, mostly Harvard undergraduate economics majors, and then one who emerged to be absolutely terrific, Jesse Downing, my co-author, who I jokingly like to say I haven't figured out whether he's 5 times as smart as I am or 10 times. By the way, I said that to a colleague one day, and he said, "Norton, how about 100 times?" And so it's been a very satisfying experience. But from it comes an injunction to all of us that we really owe it to ourselves and to our families to understand investment better than many of us do.
I'm going to get into that scope in a moment. As an author of 4 books in the trading investing space, it's pretty easy to see that the amount of work that went into your book, Investment, is astronomical. There is a tremendous amount of work to do that type of research going back literally thousands of years. To get that narrative strung together, that is a tremendous effort.
Well, let me tell you, though, it was a delight. I cannot emphasize. It was 5 years of work and with a lot of young and very bright helpers, yet it was a joy all the way. I started it as a project more than as a book, and I was a couple of years into it when I realized it could be a book, it should be a book. All the way along, despite the seeming tediousness of it, I did have help after all, it was lots of fun.
It's quite amazing to get into that level of detail. I mean, we're looking, going back to ancient Greek time, Roman time, Egyptian, bringing it up through the Asian development of markets and investing through China, Japan. Quite amazing. Before I get into that detail, though, I want one thing we were talking right there at the top on personal responsibility. Given, and you mentioned 50 years, I would love for you to offer some perspective about personal responsibility. You can take this in any direction you want, but as a man who's got that much experience on Wall Street, can you speak to personal responsibility today? For example, looking back 30, 40, 50 years ago, in terms of people's view on personal responsibility then and today. Are we in the same space? Are people not taking responsibility today? Talk about that from your perspective.
Great question, Mike. I don't think people's sense of responsibility or acceptance of their own role in their investments has deteriorated in any way. It's not that I'm saying to people, you've slipped badly. It's just that most people seem somehow to be unduly daunted by the challenges of investing. I'm not saying that all of us have to be able to do it all ourselves. I mean, it doesn't work that way. People do need help. They've got other jobs and responsibilities to their families and so on. So I'm not saying people don't need investment advisors or shouldn't have them. But what I'm saying is it's impossible for anyone else to have the full sense of your emotional, financial, and other needs. You have to be in the equation. If you're using an investment advisor, you have to be there to work with him very closely and to be monitoring what's going on because only you understand 100%, let's say, or a very high percentage, what your needs are. And that's the essence of what I'm saying. It's not that the professionals don't play an important role. They do. But it is that each of us cannot abdicate our responsibility. And so if there's a message in this book, and in fact, I was just looking at the last paragraph in the book where I sum up some of that kind of thought, that investment has become more democratic over the last few hundred years. The opportunity for the common man or woman, unfortunately, there are still people who are excluded from this, who don't have resources or savings. But many of us now have the opportunity to invest where the way only the elite were able to invest decades and hundreds of years ago. But we haven't fully accepted all the responsibilities of doing that. And for our own sakes, we need to do that.
One more big picture point that I think I'm observing correctly in this work. I didn't feel any sense of partisanship in this work. I think this is a book that anyone can read, whether they view themselves on the left or the right or the middle. I think this book reads very factual and very historically accurate, but I didn't really read into a certain partisanship. By design, I assume?
That's very perceptive. Yes, there was a real effort on our parts to keep the book neutral or not excessively judgmental. And the best example of that is probably late in the book where we discuss alternative investments and hedge funds and so on, and in the same chapter talk about ETFs and index funds. That's an example of where one could take sides. And there are little hints of what we've observed scattered throughout, but we try not to jump on, the efficient market is the only way or things of that sort, although there is some evidence to support views in that direction.
That's actually one of my points I'll get to later. But in the beginning, though, the democratization of investment, you do kind of lay out 4 key points. I would love for you to elaborate on these from the outset. You talk about real ownership, number 1, finding or seeking a value, seeking fundamental value, the role of leverage, number 3, and resource allocation, number 4. I'm paraphrasing each of those, but perhaps you could lay out for the audience your perspective on those 4 key points in investment.
Now, I have to make confession first, Mike. The confession is those judgments, which appear early in the book, were not necessarily a prescribed part of the assignment. In other words, the book didn't set out to give investment advice. And for some reason, I just couldn't resist sharing some general observations I'd made over many, many years. You've accurately pointed out that area does exist in the book, and I'm very proud of it and in love with it, if I can use that phrase. It really wasn't part of the official assignment of the book, and I gave myself a little leeway to take that liberty. But the 4 principles I talked about by way of an introduction and a background were very important to me and still are. In other words, the concept that when you make an investment, you have to think in terms of real ownership. The fact that it's a piece of paper, in most cases, that it's a stock certificate or a bond note or whatever, is not the main issue you have to grapple with. You have to grapple with the fact that you are a creditor, if it's a bond, you are an owner, if it's a stock certificate. You have to really get beyond the notion that you're just buying and selling pieces of paper. So that was the first point I stressed. And by the way, I'll rely on someone as noteworthy as Warren Buffett, who's made that point over and over again during his career. The second point is there are people who think in terms of value and growth and that sort of thing. In the end, I've come to feel over a long career that quote unquote value is what really matters. That isn't to say that growth stocks don't have real value. Value is determined by analyzing the present value of the returns you're likely to get from your investment. That is, dividends, other distributions as a stockholder, things of that sort. And growth stocks can be analyzed in the same way because given their growth, they produce earnings, and the earnings enable dividends, and the fact that they grow rapidly, if they do grow rapidly, is very important to their present value. And by the way, I should emphasize the word present value. That is, you have to look at things that are going to be earned and distributed in the future and bring them to the present using discount analysis. The third element is a sort of rebellious view of my own, which I came to feel in the course of the research of this book. I feel that we've underestimated in many cases the role of financial leverage. And we're all used to knocking financial leverage when it turns out badly, and sometimes it does. And we give some examples in the book of that. But the fact of the matter is that financial leverage has been an incredibly valuable aspect of great fortunes and great investment successes that have been made over the years. It's got to be used wisely, it's got to be used sensibly, but it is not something to be decried in all instances. There certainly are some disasters that have to be decried. By the way, sometimes the results of excessive financial leverage and the disasters that have occurred have produced some of the great values in the context of the second point I made for perceptive investors. And then resource allocation is another sort of personal, somewhat rebellious thought. I think we've learned over recent decades that CEOs who delegate with care to managers, but who control resource allocation and are perceptive in terms of the way the finances of their companies are directed over time in the major areas are sometimes the very best CEOs. And we cite a couple from not quite ancient history, but from decades ago, and one at least that runs into the current environment. But there are many out there. But it's not the popular view of CEOs. I think the popular view is people who manage frenetically every detail. But in fact, it's the resource allocation and people selection and assigning responsibility with care and thoughtfulness that turned out to be one of the greatest attributes of a great leader and investor.
One of the things I want the audience to understand about this work, from my perspective, it's a process to today. It's a timeline to today. So it is this true historical narrative. It is one of these really interesting things. If you're curious and you want to know, how did this all start? How did we get to the point, in 2016, we're looking at, ETFs, mutual funds, hedge funds, etc. What was going on in the ancient Greek time? So you really get into that level of detail.
Yes, we try to do that. And if I may interrupt for a second, Mike, forgive me. The book is written, if I can use this word, somewhat logarithmically. By that I mean we spend 60 to 70 pages on the first 3,000 years, but then we begin to get more microscopic as we move forward, so that although the book spans more than 4,000 years of history, it doesn't spend equal amounts of time on all areas. It begins to magnify more as it moves toward the present.
It should, because, what's going on in the last 50, 100 years is quite different, and there is a certain acceleration.
Yes, I believe that's true. Well said.
Let me take you to the notion of bubbles. You've had a chance to witness many market bubbles throughout your career. I don't know everything in terms of what you might say, but why don't we pick a time period or pick a particular favorite bubble of yours? We could be back in 1929. We could be at the South Sea bubble. We could be, mid 1600s in Amsterdam, and perhaps wrap some of the timeless lessons around. Because even though some of these events took place a long time ago, we're still human beings. It's still fear and greed, and these things seem to happen over and over again in a very similar way, don't they?
Yeah, absolutely. And forgive me, but my favorite bubble is the last one, because we wrote a section on comparing the Great Depression of the 30s with the Great Recession, as we've come to call it, of 2007, 2008, 2009. And I found it exciting to work. We have half a chapter on that particular Great Recession. I think it's a perfect example of a bubble. In other words, because of housing finance, lack of regulation in certain ways, and new vehicles which had been created, we created a situation where people totally lost perspective on valuations of housing, for example, and of ways to finance it. There were remarkable developments very recently in our lifetimes, but in our recent lifetimes, that we can all study. By the way, if I may insert parenthetically, I am a believer in the success of the way we handled the Great Recession. I don't know if it emerges from the pages. I think it may, but it may take a very intensive reading. We think the egregiousness of the bubble in 2006 and 7 was greater than the egregiousness of the bubble, if I can call it that, in the late 1920s. It was just that it was totally mishandled by economists and government people in the early 30s until we got well into the 30s and Keynes appeared with what turned out to be a sensible prescription. And in my opinion, although I know this is still controversial, very well handled in the 2008, 2009, 2010 period. And the book dwells on those issues, and not everyone will agree with us, but we think the case is relatively clear. But the other element I think that's worth spending some time on is what I'll call the suspension of diligence that sometimes occurs in economic booms. That is, economic success somehow leads to the expectation of more success. And economic achievement, sometimes in violation of the most judicious rules that one might follow, often leads to more of the same. And that's an example of what happened in the early 2000s period leading up to this great housing bubble. The financing mechanisms were questionable. The concept that one couldn't lose money in housing was around, and there was no evidence to support that, and so on and so forth. So I think there are some wonderful examples in the bubble of 2000, 2005, 2006, 2007 that were dealt with and reasonably effectively in 2008, 9, and 10.
Norton, let me push back a little bit and let you elaborate some. All of us can kind of go back and we can look at perhaps the 04, 05, 06 time period, and we can see those statements from Bernanke, the head of the Fed at the time, and seemingly, look, I'm paraphrasing here, but we've never had real estate go down. There is no bubble. This kind of thing, and of course, then we did have a pop, and then we went in and we've used the monetary policy to perhaps bring things back to life, so to speak. But then, would somebody be amiss to be looking at current day and saying, gosh, this kind of feels similar to the dot-com bubble popping, and we dropped rates down really low, and then we got another bubble, and then we dropped rates down really low? Would somebody be amiss if you're looking at monetary policy in the last 15 years thinking that it feels repetitive and that perhaps we could be in the middle of another bubble right now?
I think there are points to be made very validly as you've made them. In other words, that it is probable that when very low interest rates are allowed to exist for an extended period of time, it causes multiples on stocks, by the way, as well as on housing and other assets to rise. I don't think there's much doubt that one of the risks of what have been successful monetary policies for dealing with extreme problems is that they lead to a recurring situation where people get excessively optimistic about the value of assets. The one point I would make, though, I do think that some of the financial, manifestations of the last problem, subprime loans and things of that sort, are not occurring to the extent that they occurred in the early 2000s, so that we probably have a little more insulation from the difficult effects of the next excess of asset values. But the point that you're making is very valid, which is that very low interest rates do tend to cause assets to be valued more highly. That is occurring to some extent now. We see it around us. It does contain risks, so that we are not totally in the clear. And there may be new areas where these problems occur that we haven't been able to foresee based on where the problems occurred in the past.
Let me read one of my favorite sentences in the book, which I think goes right to where we're at right now. Risk is a result of a basic fallibility. That fallibility is our incapacity to see the future.
That's part of it. But sometimes I think while we have this incapacity, obviously it's the way humanity is and the way the world works, sometimes foretelling the future with a little better precision than we seem to do it out there is possible. The housing bubble of 2006 and so on probably could have been foreseen a little better than we did it at the time. By the way, you mentioned Bernanke, who was a hero to me, but he was late to the party also. In other words, Bernanke was the right man for the job, but he didn't get it on day one. He got it a little bit later. He just knew what to do when he got it.
Let me shift gears on you into something that you mentioned at the top, the efficient market hypothesis, the efficient market theory, Eugene Fama. Interestingly, we had the 2013 Nobel Prize split, two very different views of the world. And you talk about both of those, the behavioral view, the efficient market view. Why don't you add your perspective? As you say, 50 years on Wall Street, why don't you add your perspective, efficient markets versus the behavioral school?
Let me begin with a confession. We didn't have that section on behavioral finance or economics in there in the very first draft. One of the readers we had pointed out, you've got an omission here. You don't discuss behavioral finance, and so we corrected it. And of course, we tried to do a decent job on that, and we agreed with the reader who made that point. Yes, I think it's a conundrum that's not fully resolved. I mean, there are still, let's say, two sides to this story. Those who feel that it is possible to manage actively and to add value, and there are many, many people in that camp, including a lot of very famous and successful hedge fund managers, etc., and those who feel that there are varying degrees of efficiency that can be detected in the marketplace that make it very difficult to excel through active management. The book comes down in the middle, so to speak. The book says, yes, there were some tremendous innovations created in investment management, especially over the last half of the 20th century. Yes, in certain cases they worked very well, but on the other hand, as the market becomes broader, more active, and more populated by people competing to do well, it becomes more and more difficult to really have a performance over an extended period of time that is exceptional.
Unless you're doing something entirely different than everyone else.
Yes, but of course, I think we point this out in the book, being entirely different has tremendous opportunity, but it carries with it risk. Because being entirely different may mean that you're not so right either. Yes, we say that, but that is important. That's one reason why all of us as investors have to be perceptive about whether we think something is significantly different and is it in fact likely to be effective.
You brought up Warren Buffett at the top of the conversation. You have an interesting way of explaining, I believe, if memory holds true for me, it was essentially people were questioning, putting the survivorship bias argument out, saying, hey, perhaps Warren Buffett is just the lucky guy that's left over. And he goes on to elaborate multiple people that he knows, and you talk about some of the probability for that to just be chance. Why don't you relay that story?
What I would like to say is one of the things, when we talked about financial leverage before, one of the things that has not been adequately understood about Warren Buffett's success, and we mentioned it in the book, we refer to an article that we read as background for part of the book, that Warren Buffett's success has been somewhat based on the fact that he's been able to use leverage amazingly effectively because of his discovery early in his investing career of the leverage advantages of insurance company reserves. He has borrowed money at less than the federal government, percentage point or so less than the federal government, over his entire career, the result giving him an advantage of outperformance. Secondly, he has been, we all have to agree, a very intelligent, value-oriented investor, and that has raised his odds a lot. But I think we're also finding now, as Warren Buffett's vehicle, Berkshire Hathaway, of course, becomes larger and larger, it becomes more and more difficult for him to perform better than the economy. But he still does some interesting things. For example, his work with what are the Brazilian entrepreneurial group called 3G, I think, in taking on some private investments at very attractive multiples and executing the reformation, if I can call it that, of these investments as they have, the 3G group has done, give him other advantages. We're remaining somewhat cautious about the idea that anyone can, over vast sums and vast numbers of years, continue to outperform. But one has to have respect for Mr. Buffett. He's done some pretty remarkable things over the years.
So you think anybody that comes with the survivorship bias argument would be wrong, on the wrong side of the debate?
Well, I'm not exactly sure what you mean by the survivorship bias argument in this case, but Buffett has done some remarkable things. I mean, you've got to acknowledge great brilliance and discipline. He's done it for many, many decades, actually, so one has to have respect for that performance. I guess I'm also saying that it would be difficult to forecast, and I think he agrees with this, that he could outperform the S&P 500, for example, by much in the years to come.
I guess to end that point there, the thing is that there's something to be learned from him, is what I'm really getting at. For some,
I agree with that.
Yeah. Let me shift into going from one of the most heralded investors, most successful, to the worst case studies in the history of investment, and that'd be Bernard Madoff. I would love for you to perhaps pass along what might be your favorite bit of insight from the Madoff escapade? But my bigger question to you is, are we facing a situation right now, unbeknownst to us, where Madoff Part 2 exists and is in operation today under another name, another auspice? Is it possible that there's another one as big as Madoff out there today?
Madoff was big. I myself, who had been in the business of analyzing investment managers for years, and for some reason never ran into Madoff, and had done many transactions, in fact over 70, was astonished when I first heard about the Madoff thing. I said it couldn't be. Nothing that large could have happened without having been detected. Madoff was a remarkable event in its scope. One of the keys to Madoff's, the problems with Madoff, was that he was a broker-dealer, and he was not using independent custodians to hold his securities. And the result was, one result of that gap, and it was really a gap, was that there was no one monitoring whether these transactions were really happening. If there had been an independent custodian having to hold securities, there is a chance, a very good chance, I think, that Madoff would have been caught much earlier, and the extent of the fraud would have been limited and eventually and solved many years ahead of time. Is there a possibility there are other Madoffs occurring today? Of course, but they're becoming, as we move forward in regulation and fraud, the detection and fraud minimization, if you will, we get a little bit better and a little bit better. And so fraud becomes more difficult, market manipulation becomes more difficult, insider trading becomes more difficult. It's part of this democratization process we talk about. But impossible? No, not impossible.
You know, Norton, as you mentioned, you've seen a lot of fund managers in your career, and that's been a good part of your career. The potential investor out there now is looking at a prospectus, and they're looking at perhaps a 20-year track record. And that 20-year track record, just as a hypothetical to you, that 20-year track record shows every month a positive 1%, just the most consistent 1% every month for 20 years. Your red flag is going up immediately, isn't it?
Yes, 1% a month would mean 12% a year, and that you have to take on risk in order to produce a return as high as 12% a year. So I would say yes. I would be deeply skeptical just on the basis of those numbers. Now, if it were a tenth of 1% a month, you can do that practically risk-free. But once you begin to get up to higher return aspirations, you begin to have to take on risk. And if you take on risk, you're going to get volatility. And if you take on volatility, there are going to be fluctuations in returns. And so, yes, I would be deeply skeptical of those numbers, indeed. As you say, quite frankly, there is no superior return without accepting above zero risk.
You know, one of the things you talk about in the book, too, is risk today, and that risk becomes often, many times, and we've seen this in perhaps best in fall of 2008, becomes the same at one time. There's a common source of risk. You potentially have these the black swan events happening at this point in time. Why don't you speak to the idea where we can seemingly feel like we're diversified, we think we've got a handle on the correlations, and then boom, everybody is correlated in all instruments the same, and the risk is just magnified off the charts.
The increasing, I'll use the word, financialization of ownership and risk has tended to raise the commonality of exposure. And we saw that again in the housing bubble. The fact that housing was no longer locally financed entirely, that the major ownership was done through securities and derivatives and so on, securitization, increased the commonality of risk. Speaking for myself, I understood reasonably early that there was exposure in housing growing. But what I failed to understand until much later was how this exposure was being distributed throughout the world, not just even the United States, and being distributed through securitization. And so in the world we have today, the financial world, the global economy that we have today, more commonality and more coherence, in a dangerous way, of risk has come along. And the exposures are broader than we sometimes think, and broader than they were 50 years ago, 100 years ago, etc. And the villain here is, even though it has some very good features, is the fact that we've securitized so much in this world.
If I bring up tail risk for a moment in this same vein, going back the length of your career, going back 50 years, and often traders and investors would perhaps have a better understanding or usage of, or a better way to manage a tail risk or understand it than the academics. The traders and investors always seem to be there ahead of time. But going back and thinking about your career, and look, we have the Black Swan book out now, and Nassim Taleb has brought up tail risk, but tail risk is not necessarily a new idea. How did you think about tail risk as a young man on Wall Street, and throughout your career? How would you best describe your thoughts on that?
Well, one way to describe tail risk that's maybe a little homely, but has meaning for me is, you've often, or on frequent occasions, seen discussion of the fact that, well, this is a 1 in 100 year event. That's tail risk, put in homely terms. The fact of the matter is, though, and I think maybe it's even somewhere in the book or in some other paper I wrote somewhere along the line, the fact that it's a 1 in 100 year event doesn't mean the years can't be next year. That's the essence of tail risk brought to a homely kind of a level. The fact of the matter is, things can be rare and unlikely, but that isn't the same as saying they're impossible. And so we have to be sensitive to the fact of whether conditions are going to an extreme that can produce 1 in 100 years, so to speak, kind of events. And what's the firm in the 90s? Long-term capital management.
Yep.
Long-term capital management was an extremely successful hedge fund, and they had concepts that were very interesting. By the way, a couple of Nobel Prize winning economists on their advisory board. But the fact of the matter is, they were operating with government securities at 100 to 1 leverage. 100 to 1 leverage, even with the most secure types of investments, means that even a 1% fluctuation is enough to wipe you out. That's what we all have to be sensitive to, the fact that something is rare and unlikely to occur is not the same as saying it's impossible.
Let me shift gears on you again. It's easy to shift gears in this book, Norton. You know that there is so much detail. Really.
Yeah, and that was part of the fun of it. And I apologize for the 80 pages of endnotes that
I've got about 7 pages in front of me right now. Not the book in front of me and about 7 pages of notes. But here's where I want to go. So it's not an omission. You do talk about the quant style, momentum style, trend style investing strategy. You do talk about that in the book. And I can think roughly in my head, probably in the last 15 years, assets under management from a few billion to, I don't know, maybe even close to a couple $100 billion, maybe more now. But you do take a pretty straightforward, foundational, classic view in this text about value. From your perspective, and once again, you've looked at a lot of fund managers and funds over the years, speak to quant style, momentum style trading, investing, and contrast that. What are your feelings?
Let me start with the fact that quant style is not necessarily limited entirely to momentum. There are many artificial intelligence aided decision-making techniques that are not the same as momentum. I wouldn't want to say anything to dismiss quant style, with a broad brush. Let's also face the fact that I think if you're dealing with commodities and things of that sort, that where valuation is difficult, momentum theory may be the key to success. Speaking for myself, however, the principles articulated early in the book are the ones that work for me. I'm not trained or computer aided to the point of being able to operate second by second to catch momentum developments and observe reversals, so that I have to treat them with respect, but with caution personally. But it's possible. However, I must admit, just as a more fundamentally oriented investor, and that doesn't exclude growth or companies that have momentum of a fundamental basis, I find it difficult to grasp what I think maybe a good 65% of the current trading on the exchanges, which does seem to be driven by very short-term considerations and by very momentum-oriented concepts. I'm not smart enough to dismiss them, but I am wary enough to decline to participate in them.
Norton, as I wind you down, I can't keep you all day. I would probably just sit here and pick your mind all day, but I know you got stuff you got to do. Let me wind you down.
I hope there's enough for you to be picking at.
Let's bring this up to today. So I think this gets back to the original big picture. We've touched on a lot of topics, but I can see that your real motivation is to lay out all these topics for people and say, look, you got to think about this stuff. This is part of the landscape. You can't ignore it. You can't dismiss it. You got to be cognizant of it. Where does that leave us today? Where does that leave the average investor today? Because we can look at a situation right now in 2016 where, wow, there's been some serious movement on the U.S. stock indices since the March of 2009 lows. And so it's an interesting time to be picking up investment, a history. I'm holding it in my hands from the Columbia Business School, and it's over 300 pages, and it paints a picture of a lot of up and down. Wouldn't it be unusual for people to be a little bit concerned today, would it?
Well, one dare not be a little bit concerned on any day. So, yes, I certainly agree with that, Mike. One has to be cautious, and certainly we've had, a 7-year bull market, in effect. We've had dramatic appreciation in stocks and dramatic recovery in the economy, even though many are decrying the fact that the pace has been slow. The fact is we've had a very substantial recovery. And we have very, very low interest rates, but they work together. I'm an investor myself. I'm in some ways doing more investing than I ever did before, because most of my career was in management of investors rather than in investing myself. And of course, at this point, that's different. I don't have managerial responsibility. But my reaction to today's environment is that the very low interest rates we have at the present time have changed the ball game a lot. One of the changes they've made is to create the logical attitude. Lower discount rates would be a more appropriate way to phrase it. That is, the rate of interest determines the level of multiples that are supportable in equities. And for example, when I look at, and forgive me for mentioning a security, when I look at the triple Qs, which you know and probably most of your listeners know, are the 100 largest holdings in the NASDAQ and are an ETF of a sort, I look at the multiple there, which is in the mid to high 20s, and I say that's a high multiple, but compared to where it's been at other times, for example, in 2000, it may not be as excessive as it could be given the fact that interest rates are as low as they are. So I think a lot of things depend on interest rates and what they do to the valuation of assets. We talked about this at the very outset. We have to be sensitive to the fact of whether we're in an environment where low interest rates, certainly not as low as today, I would imagine, and not negative for extended periods of time, could continue and justify somewhat higher prices than before. But when the prices get really crazy, and we know they were really crazy, for example, in the NASDAQ 100 in around the year 1999 and 2000, one has to be guarded.
It's a tricky situation. I mean, I think everyone would agree that in March of 2009, to bring everything back, that makes people happy. But on the flip side, I guess there's plenty of people that perhaps saved money for an entire career, and then they get to their retirement years, and perhaps today they just don't have income anymore. And the pushback might be, well, hey, gosh, I really don't want to have to take on that risk in equities now at an advanced age. They just don't have that income. It's a trade-off. I don't think the average investor really understands how that got made.
Yes, and it's a very difficult situation. I have many friends who I'm an equity investor lifelong, and so I'm used to taking those kind of risks. It doesn't mean I'm always successful, but yes, I have many friends, both less resources and some with more, who are very disturbed by the fact that earning relatively safe, decent returns has become extraordinarily difficult. I am sympathetic and hopefully realistic about the fact that is a problem. I have no answer for it, but I do feel the fiscal and monetary policies that led us to where we are in this recovery were correctly executed. It's just that some of the consequences, there are always consequences, and yes, there have been very unfair consequences for those living who are unwilling or unable to take some risk in order to get reasonable returns.
Norton, the book, Investment, A History, Norton Reamer, Jesse Downing, Columbia Business School, it's available everywhere, right?
Yeah, yes, it is, including on Amazon.
That's pretty much become everywhere today, right? Amazon is everywhere.
Yeah, well, it's true. I see it in my own household. There's a package at the door every day. Yes, let me just say one last thing about all that. The joy of writing this book for me personally, and I think for Jesse, was unbounded. I mean, it seems like a demanding book and maybe somewhat scholarly book, but it was great fun to delve into some of the principles and facts of history as it affects investment.
And I have to say, just a few quick points. Italian merchant banks, 10th century, the South Sea bubble, the Industrial Revolution. We have just barely scratched the surface today. So I want people to understand that there's quite a bit here.
But also, I would like to emphasize that it comes to the present.
Yes.
And it has points of view and analysis of different techniques and activities that have occurred in the last 50, 25, 10, 5, and right now, years.
Your log chart example is a good way to think about it. It's a build. It's building to something, which is current day.
Right. Well, so again, thank you for enabling me to relive some of the joy of this undertaking. It's been a fun project.
Thank you, Norton. I appreciate you taking the time today.
Nice to talk, Mike.
I see a time when those awake will understand how to make money in up, down, and surprise markets. Whether new trader or experienced, college student or financial advisor, protecting against a crash or just trying to make a lot of money, trend following offers everyone an answer in uncertain times. To get started immediately, send me an email, michael@covel.com. I will send you the right trend following steps to take along with my free video. But if you want to buy and hold, trust the government and trust Wall Street, this is absolutely not for you.